Good morning, traders, investors, and welcome back to Market Meridian, your compass for navigating the crossroads of global commodities, macroeconomics, and technical price action. I am Eric. Today is Friday, April 24th, 2026, and we are breaking down two of the most critical assets driving risk sentiment this week, spot gold and Brent crude oil. Over the past 24 hours, we've witnessed a textbook case of market paradox. Two assets that often move in lockstep during geopolitical shocks, but today, they're on opposite trajectories. Gold is down nearly 1% at the time of recording, while Brent crude is surging over 4.5% in a single session. What's driving this divergence? What does it mean for today's trading session? And how do technical signals align with the fundamental narratives? Let's unpack this, frame by frame. First, we need to make the 24-hour performance breakdown. Brent crude oil, a historic surge. Let's start with the commodity that's making headlines this morning, Brent crude oil. At the time of recording, it's trading at $106.41 per barrel, up $4.65, or plus 4.57% in the past 24 hours. Let's walk through the price action step by step, from the opening bell to this morning's highs. Opening context. Yesterday's session opened at $101.57, with a low of $101.31 and a high that pushed to $107.35, its highest level since early March. The previous close was $101.76, so we've seen a near vertical move of over 5% in just one trading day. Looking at the 60-minute time frame, the uptrend is undeniable. Price has been making higher highs and higher lows since the early hours of April 22nd, with moving averages acting as dynamic support. The MA5 sits at $105.27, the **MA10 at $103.97**, the MA20 at $103.61, and the MA40 at $101.92. Every single moving average is sloping upward, confirming the bullish trend structure. MACD on the 60-minute chart is also flashing bullish signals. The histogram has turned positive, with the MACD line crossing above the signal line after a brief dip into negative territory. This suggests that short-term buying momentum is accelerating, not fading. Daily chart is zooming out to the daily time frame. We see this move as a continuation of a larger recovery. After hitting a low of $92.06 in mid-April, Brent has been on a steady climb, reclaiming key moving averages. The MA5 is at $98.69, MA10 at $97.38, MA20 at $100.81, and MA40 at $97.39. The price is now broken above the 20-period moving average, a critical signal that the medium-term trend is shifting from bearish to bullish. MACD on the daily chart shows the histogram contracting from negative territory, with the MACD line attempting to cross above the signal line. This is a classic bullish crossover setup, suggesting that the medium-term downtrend from March's highs is losing steam. Now, why is oil surging? The answer lies in the intersection of geopolitics, supply fears, and macroeconomic expectations. And OPEC plus production discipline. Compounding the supply fears are signs that OPEC plus members are adhering to their production cuts, with several major producers extending voluntary reductions through the second quarter. This tightens the global supply-demand balance, putting upward pressure on prices. Spot gold, a counterintuitive sell-off now. Let's turn to the other side of the coin, Spot gold. At the time of recording, it's trading at $4,694.07 per ounce, down $45.98, or minus 0.97% in the past 24 hours. This is a sharp pullback from yesterday's open of $4,744.49, with a high of $4,753.24 and a low of $4,664.28. Let's analyze the technicals. In daily chart, the daily chart paints a bearish picture for the short term. Gold has been in a downtrend since its March peak of $5,419.01, with a sharp sell-off that bottomed at $4,099.02 before rebounding into April. The MA5 sits at $4,761.70, **MA10 at $4,772.04**, MA20 at $4,702.30, and MA40 at $4,832.09. Notice that the price is now below the 5-period, 10-period, and 20-period moving averages, which are all sloping downward. This is a classic death cross setup, indicating that short-term momentum is firmly bearish. MACD on the daily chart is also showing signs of weakening momentum. The histogram, which had turned positive during the April recovery, is now shrinking, with the MACD line beginning to cross below the signal line. This suggests that the rebound from the March lows is stalling, and sellers are regaining control. Now, the million-dollar question: why is gold falling when geopolitical tensions are rising? Isn't gold supposed to be the ultimate safe haven? The answer lies in a complex interplay of competing forces, oil-driven inflation expectations. As we discussed earlier, the surge in oil prices is stoking fears of persistent inflation. While gold is traditionally an inflation hedge, the market is currently pricing in the opposite effect. Higher oil prices, higher inflation, higher interest rates, a stronger US dollar, which makes gold, a non-yielding asset, less attractive to investors. Real yields and dollar strength. The US dollar index has been relatively resilient this week, supported by expectations that the Federal Reserve will keep rates higher for longer to combat energy-driven inflation. Higher real yields make gold, which pays no interest, less competitive against bonds and other income-generating assets. Profit-taking after the March sell-off. Gold had rebounded roughly 15% from its March low of $4,099 to a high of $4,800 in mid-April. Some traders are using the current geopolitical uncertainty as an opportunity to take profits, adding selling pressure to the market. This is the gold paradox of 2026. Rising geopolitical risk is boosting oil prices, which in turn is weighing on gold via the inflation interest rate channel. It's a rare but powerful dynamic that we are seeing play out in real time. The correlation conundrum: why gold and oil are moving opposite. Before we dive into today's forecast, let's take a moment to unpack the relationship between gold and oil. Because understanding this is critical to navigating the current market. Historically, gold and oil have had a weak positive correlation. Both are seen as hedges against inflation, and both tend to rise during periods of geopolitical uncertainty. But as we are seeing now, that correlation can break down under specific conditions, inflation versus growth. When oil prices rise due to supply shocks, like the current situation, it can lead to stagflation fears, high inflation paired with slow economic growth. In this scenario, central banks are forced to hike rates aggressively to fight inflation, which strengthens the dollar and weighs on gold. Dollar dominance. The US dollar is the world's reserve currency, and both gold and oil are priced in dollars. When the dollar strengthens, it puts downward pressure on both assets. But in the current environment, the dollar is being supported by rate hike expectations, making it a headwind for gold, while oil is being supported by supply fears. Safe haven versus inflation trade split. Geopolitical risk is driving oil prices higher via supply fears, but not gold, because the market is more focused on the inflationary impact of oil than the direct risk of conflict. In other words, traders are treating oil as a geopolitical play and gold as an interest rate play right now. This split is rare, but it's not unprecedented. We saw similar dynamics during the 1970s oil shocks, when gold initially rallied but then fell as the Fed hiked rates. Aggressively to combat inflation. Today's market is echoing that same pattern, albeit in a more modern, interconnected financial system. Coming to today's technical and fundamental forecast now, let's turn our attention to what this means for today's trading session. We'll break down the forecast for Brent crude oil first, then spot gold, combining technical signals with fundamental catalysts to map out potential scenarios. Brent crude oil, bullish momentum, but resistance looms. Technical outlook. Brent crude is in a strong short-term uptrend, but we are approaching key resistance levels that could trigger profit-taking. Let's map out the key levels. Resistance levels. Immediate resistance, $107.35, today's intraday high. A break above this level would open the door to the March high of $119.45. But that's a long shot in the short term. Secondary resistance, $110, psychological level. This round number could attract selling pressure from traders looking to lock in profits. Support levels. Immediate support, $103.97, MA10 on the 60-minute chart. If price pulls back, this level could act as dynamic support. Secondary support, $101.76, yesterday's close. A break below this level would signal a potential trend reversal, with the next support at $100.81, MA20 on the daily chart. Fundamental catalysts to watch today. Middle East geopolitical updates. Any news on the US-Iran ceasefire talks will be the primary driver. If tensions escalate, we could see a further spike in oil prices. If there's progress toward a new agreement, we could see a sharp pullback as the geopolitical risk premium unwinds. U.S. Inventory data. Later today, the EIA will release weekly crude oil inventory data. A larger than expected drawdown, indicating strong demand, could add fuel to the rally, while a build could trigger a pullback. U.S. Dollar movements. A stronger dollar could cap oil prices, while a weaker dollar could provide additional tailwinds. Scenarios for today. Bullish scenario, 60% probability geopolitical tensions remain elevated, and the EIA data shows a drawdown in inventories. Brent crude breaks above $107.35, targeting $110.00. Bearish scenario, 30% probability there's progress in ceasefire talks, or the EIA data shows a build in inventories. Brent pulls back to test the $103 to $104 support zone. Neutral scenario, 10% probability the market consolidates between $103 and $107, as traders wait for more clarity on geopolitics and inventories. Spot gold. Bearish pressure, but support awaits. Technical outlook. Gold is facing significant short-term bearish pressure, but there are key support levels that could halt the sell-off. Let's map out the levels. Resistance levels. Immediate resistance, $4,702.30, MA20 on the daily chart. This moving average is now acting as a dynamic resistance level, secondary resistance, $4,761.70, MA5 on the daily chart. A break above this level would signal a potential trend reversal, but that's unlikely in the short term. Support levels. Immediate support, $4,664.28, today's intraday low. A break below this level would open the door to the March low of $4,099, but that's a worst-case scenario. Secondary support, $4,600, psychological level. This round number could attract buying interest from long-term investors. Fundamental catalysts to watch today: U.S. economic data. Later today, we'll get U.S. durable goods orders and consumer sentiment data. Strong economic data could reinforce expectations of higher rates, weighing on gold. Weak data could ease rate hike fears, providing a boost to gold.U.S. Dollar movements. As we discussed earlier, gold is inversely correlated with the dollar. A stronger dollar will keep pressure on gold, while a weaker dollar could provide some relief. Geopolitical risk sentiment. While the direct impact of geopolitics on gold has been muted so far, a major escalation could trigger a flight to safety, leading to a sharp rally in gold. Scenarios for today: bearish scenario, 55% probability strong U.S. economic data reinforces rate hike expectations, and gold breaks below $4,664. Targeting $4,600. Bullish scenario, 35% probability weak U.S. data or A. Major geopolitical escalation triggers a flight to safety, and gold bounces off support to test $4,700. Neutral scenario, 10% probability gold consolidates between $4,650 and $4,700, as traders weigh competing signals from oil, rates, and geopolitics. The big picture. How to trade this divergence now that we've broken down the technicals. And fundamentals. Let's talk about how to approach this market as a trader or investor. The key here is to recognize that we are in a market driven by competing narratives, and the divergence between gold and oil is unlikely to last forever. For oil traders, long-term players, the geopolitical risk premium is likely to keep oil prices elevated in the near term, but be wary of overstaying your welcome. If tensions de-escalate, we could see a sharp correction as the risk premium unwinds. Short-term traders, look for pullbacks to support levels, like $103 to $104, to enter long positions, with a stop-loss below $101. Target should be set at today's high of $107.35 and the psychological level of $110.00. For gold traders, long-term investors, the fundamental case for gold remains intact, with central bank buying and long-term geopolitical uncertainty supporting prices. The current sell-off could be a buying opportunity for investors with a multi-year horizon. Short-term traders, avoid chasing the sell-off. Look for signs of support at $4,600 to $4,650 to enter long positions, with a stop-loss below $4,550. If gold breaks above $4,700, you could see a short-term bounce to $4,750. Key risk management reminder: volatility is likely to remain high in both assets today, so it's critical to use stop-loss orders and avoid over-leveraging. The geopolitical situation in the Middle East is fluid, and a single news headline could trigger a sharp reversal in both markets. For today's session, keep a close eye on three things: geopolitical updates from the Middle East, U.S. economic data and its impact on rate hike expectations, key technical levels in both gold and oil. The market is telling a story, and it's up to us to listen. Whether you're a day trader or a long-term investor, the key is to stay flexible, manage risk, and let price action be your guide. Thank you for joining us on Market Meridian. We'll be back tomorrow with a full recap of today's price action and an updated forecast for next week. Until then, trade safe, stay sharp, and remember, in the markets, the only constant is change.